Good morning, everyone, and thank you for being with us here today. I am Olajide, the founder of Tax House. Allow me to quickly thank and appreciate the chairman of FIRS, Mr. Mohamed Nami, the chairman of LRS, Mr. Femi Olarinde, Mr. Toby Wojuola, the panelists, and the board, our tax house, and all our partners and the tax house team for putting together this wonderful webinar. The main reason why we have decided to have this webinar is to give taxpayers within the maritime shipping and aviation sector the opportunity to learn about how to comply with the tax laws, and also for the taxpaying public to understand the aviation, the maritime and shipping space. On this note, I would hand over to Mr. Larinde, who is a wonderful anchor for today, to take over. Thank you very much.
Hello, is everybody there? Olajide, are you there? Hello? Hello? Hello, is everyone on? All the panelists, Olajide, are you there? Sorry, listeners, we are having some technical itch, and very soon we are going to commence the webinar. The people at the back end are working tirelessly to ensure we have a itch-free webinar today. Please be patient with us, and thank you for participating, for joining this webinar this morning. Thank you. I'm the representative of the FRS chairman, but okay, it's available right now. I will call on Mr. Manasseh to give his opening remark. Mr. Manasseh, he will be representing the Director Taxpayer Service Department. Mr. Manasseh is an Assistant Director in the service and is presently the head of the man in charge of the FRS Contact Center. So I will give him the floor to give the opening remark because it's the part to give the opening remark as we start. Thank you very much, Mr. Manasseh. You have the floor, please. Thank you.
Good morning, all.
Good morning.
The Executive Chairman, FRS, coordinating directors of various groups, the group leads of various groups, directors and head of departments, head of functions, tax practitioners, external stakeholders. I want to welcome you once again to the second series of our webinar. This time around, the focus is on taxation in the maritime, shipping, and aviation sectors. The Tax House, in collaboration with the FRS Federal Inland Service, has put together this webinar. And it promises to be very interesting as we have speakers and experts who will be taking you through in the various sectors as mentioned above. We want to thank you for creating time to be here. We believe that we're going to find this very useful to our various engagements. Once more, on behalf of the Director, Taxpayer Service Department, Alhaja Saadatu Yeru, I want to welcome you all into this great webinar series, number 2 in 2022. Thank you.
Thank you very much, Mr. Manasseh, for that opening remark. We appreciate you finding time to represent the Director Taxpayer Service and, by extension, the Executive Chairman of the FIRS. This morning, the Tax House, in conjunction with the service, is bringing this webinar to you to give our taxpayer, our teeming taxpayer, the opportunity to understand the taxation of the maritime shipping and aviation industry. And it promises to be an exciting one. We'll be having paper presentations from experts in the field of taxation, experts in the field of maritime, experts in the field of shipping, experts in aviation, and also those from the states. It promises to be an exciting time. Without much ado, I would like to open the floor by calling on our first presenter, Madam Chiza Uba, to make a presentation of an overview of the maritime and shipping industry. Madam Chiza Uba, are you there? You can unmute yourself and make your presentation. You can, Madam Chiza Uba is a practitioner from a legal firm, and she's going to do, so that I will not mother our introduction. I would like you to do your introduction as you wish, as you like. Thank you, ma'am. You have the floor, ma'am.
Thank you. Good morning, everybody. My name is Chisa Oba. I'm a partner in the law firm of Denton's Acres Law, a global law firm, and we have offices in over 200 countries in the world. In Nigeria, we have offices in Lagos, Abuja, and Port Harcourt. We have many departments. I am in the shipping and litigation department of the firm. So without much ado, I'll go into my presentation. If you can please help me put up the slides.
Olajide and Adams, please put up the slides so that we can. Okay, good. Thank you.
Thank you. Okay, the second page, please. Okay, this is just introduction to show that there are two arms. There's the international shipping, and there's the domestic one, the cabotage in Nigeria. Quickly moving on. Yeah, the Nigerian shipping industry presents very good opportunity for lucrative investments for Nigerians and for foreign investors. About 85% of the external trade in Nigeria, most of the trade in Nigeria is through shipping, comes in through shipments. And so it's a very viable industry in Nigeria. The industry, for some reason, contributes only about 1.6% on the average to the GDP, notwithstanding the size. Then the investment opportunities in the Nigerian shipping industry include carriage of goods and passengers by sea, shipping activities in the offshore industry, in the oil and gas industry, tanker trade, port services, jetties, ship chandling, you name it. There are so many opportunities in the industry for everybody who's interested. Next slide, please. Yeah, the resources that we have in the maritime industry are also very, very many. You have the human resources, we have the crude oil, which has dwindled quite substantially. We have the gas reserves. Nigeria is also located in the Gulf of Guinea, which is a very important trade route for Europe and Asia, for carriage of goods to Europe and Asia. That is why the problems in the Gulf of Guinea is quite a bit of a problem for almost the entire world. It seems to be a bit of a problem now that everybody's interested in because of the importance of the Gulf of Guinea. Then Nigeria has 6 major seaports, about 6 major oil terminals, over 160 private jetties, 4 major inland container depots, and 2 inland freight stations, and all the other resources that we also have. Please, next slide. The key players in the industry include the regulators, that's the regulators, the government regulators, the port terminal operators, the ship owners and operators, the seafarers, insurers and financial institutions. Of course, under insurance, we also have there the P&I clubs, the stevedores, the chandlers, and all other opportunities you have in the industry. Like I said, it's a very, very vast industry. So there are too many opportunities in that industry. Then other professionals like us, of course, the maritime lawyers. The next slide. Then the regulators in the industry, you have the Nigerian Maritime Administration and Safety Agency, NIMASA. NIMASA is the major regulator of the industry. NIMASA is responsible for administering the major maritime legislations we have in Nigeria, like the Merchant Shipping Act, the Cabotage Act, the Suppression of Piracy Acts, and quite a few other laws that we have in Nigeria. NIMASA is the major regulator. The ship registry is under NIMASA, and a lot of other, the maritime labor safety, they are all under NIMASA, all major maritime issues. NIMASA is also responsible for Nigeria's ensuring that Nigeria complies with conventions, international conventions that Nigeria has ratified, that NIMASA helps in pushing for them to be enacted as law in Nigeria. NIMASA just general regulation of the maritime industry. Then the Nigerian Ports Authority regulates the ports. The Nigerian Ports Authority was created by the Nigerian Ports Authority Act. It regulates the ports, is responsible for berthing and taking care of and smooth passage and pilotage of ships that come to Nigeria from international waters, and also regulates all the ports and harbors in Nigeria. The Nigerian Shippers Council is the next one, was created by the Nigerian Shippers Council Act. Nigerian Shippers Council Act, its functions is protecting the interests of shippers in the shipments and imports and exports to and from Nigeria. It was sometime in 2015 appointed the economic regulator of the ports. This has, however, not been enacted into legislation for now. Then the Nigerian Inland Waterways Authority, the NIWA, was created by the NIWA Act and regulates the nation's inland waters. The Nigerian Customs Service Board was created by the Customs and Excise Management Act, and it monitors entry and exit of cargo, and it's in charge of excise, the excise issues in Nigeria. Everybody who has imported or exported from Nigeria will be quite familiar with Nigerian customs. Then we have the Nigerian Content Development Management Board, which was created by the Nigerian Oil and Gas Industry Content Development Act. This board is not quite in the maritime industry, but because the maritime industry is closely related to the oil and gas industry, the board's activities also affect vessels, as you will see as I proceed down my slides. The board's activities also affect vessels, so the board is also somehow, the board's regulations also applies in the maritime industry because of this close relationship between the maritime and the oil and gas industry. The next slide, please. Thank you. Then the legal framework. The laws regulating the maritime industry in Nigeria include the Constitution of the Federal Republic of Nigeria. The Constitution confers jurisdiction for admiralty matters on the Federal High Court of Nigeria. Then the next one is the Admiralty Jurisdiction Act. The Admiralty Jurisdiction Act defines the admiralty jurisdiction of the Federal High Court, the mode for the exercise of the admiralty jurisdiction, and other related matters. Then the next one I have here is the Coastal and Inland Shipping Cabotage Act. The Coastal and Inland Shipping Cabotage Act was enacted to help grow indigenous capacity in the Nigerian domestic industry. Because before the Cabotage Act, the Nigerian domestic maritime industry was mainly sorry, forgive me, what's the word I'm looking for? You had mainly foreign operators in the Nigerian domestic industry, in the oil and gas industry. Most of the offshore service vessels we had were all controlled by mainly foreign interests, foreign investments. There was very little to very negligible amount of indigenous capacity in the industry. The Cabotage Act was enacted to correct this. And since the enactment of the Cabotage Act, actually, you find that the Nigerian capacity in the industry has grown. Most of the operators in the industry now have Nigerian interests in them. You will rarely find any operator in the industry without any Nigerian interests in them. Then the Nigerian Oil and Gas Industry Content Development Act, which I had mentioned when I was talking about the NCDMB, the Nigerian Oil and Gas Industry Content Development Act was also enacted to increase local capacity in the oil and gas industry. And this act also affects the maritime industry because of the close relationship between the maritime industry and the oil and gas industry. The NOGIC Act provides for the ranking and pre-qualification of operators in the industry. And based on the NOGIC Act, the NCDMB pre-qualifies and categorizes and ranks vessels for contracts in the industry. The next statute I have here is the Nigerian Maritime Administration and Safety Agency Act. The NIMASA Act was passed in 2007, and it created the NIMASA, sets out the powers and functions of the NIMASA. The Nigerian Ports Authority Act also created the Nigerian Ports Authority, the NPA, sets out the powers and functions of the NPA. Same thing with the next statute there, the Nigerian Inland Waterways Act, the NIWA Act. Thank you. The next slide, please.
Sorry, Ma, if I may cut you. If you would like you to speak on the business angle and any other, because your time, you actually had 10 minutes and you've already taken 10 minutes.
Oh, I finished 10 minutes already. Oh my
yes,
God. I'm almost done. I'm just on the challenges now and I'll finish.
2 minutes more, Ma. Thank you.
Thank you. Okay. So the challenges in the industry that investors find, the challenges we have in the industry is financing, because vessels are high net worth assets. To get them, you definitely need financing. And so getting suitable, affordable financing is always a challenge in the industry. Then security. The security is also a problem in the industry. We are all very familiar, or at least we must have heard about the situation in the Gulf of Guinea. And then corruption, of course, that we are all very, very aware of in Nigeria. It's also affecting matters in the maritime industry. Inadequate infrastructure is another problem we have. Is another challenge that the industry has. The bad roads. We're all familiar with the situation we have in Apapa. We've had in Apapa for some time now. The ETO was introduced to help with this situation. It helped a little, but we still have the problem there. Then the training of seafarers. We still have the challenge. We don't have adequate provisions for the training of seafarers. There's no national shipping line for sea time for seafarers. NIMASA sometimes actually have to mandate foreign ship owners to give sea time experience to the Nigerians. So that is not quite a very efficient method to tell them to help you in training your manpower to take over the industry. Then the last one I have there is the low incentives. There's not much fiscal incentive for the indigenous operators in the industry. The DG of NIMASA announced last year that the federal government has approved removal of import duty for vessels brought into Nigeria, but that has not been passed into law, and that has not yet started happening, because presently foreign investors can bring in vessels into Nigeria using the TI without paying duty. But once a vessel is owned by a Nigerian, the owner of the vessel will have to pay duty before importing the vessel into Nigeria, and that's a very, very big advantage to him bringing in the vessel into Nigeria, and that affects his being able to take advantage of all the advantages that the Cabotage Act gives him and the NOGIC is trying to give him in the industry. This takes away from all the benefits he would have gained from those acts, his inability to bring in the vessel as seamlessly as foreign ship owners. I think that's about all I have now for now. Then in conclusion, I'll just say that there are lucrative opportunities for investment in the industry for Nigerians, especially considering the Local Content Acts we have, the Cabotage Act and the NOGIC Act, which are aimed at developing indigenous capacity. And there are a lot of benefits there for Nigerians, for them to take advantage of and invest in the industry. Thank you.
Thank you very much, Madam Chisa, for that presentation. It quite shows a lot about the industry. From your presentation, I can see we have about 7 regulators and about 8 or 9 law guiding it's such a big industry. I won't say whether it's over-regulated or under-regulated. However, what we are about today is to speak about the taxation of this industry. And the next person I'm going to call to come on board to speak to us, I would like someone who will be speaking about the taxation policy this time around of the industry. I'll be calling on Mr. Kehinde Kajeshomo. Mr. Kehinde Kajeshomo is a seasoned tax practitioner, an accountant, and international tax experts. Mr. Kende Kajeshomo is the head, Treaty and International Tax Division of the Tax Policy and Advisory Department in the Federal Inland Revenue Service. He's a deputy director, and of course, when you hear him speak, you know he's seasoned. Mr. Kende Kajeshomo, you have the floor, please, and you have 10 minutes, sir. Thank you.
Thank you, Mr. Olarinde. It is my pleasure to be here. Thank you so much. I will try and do justice to the presentation within the time allotted. So my area of intervention will be in the area of the taxation of the industry. That's how the shipping and air transportation business is subject to tax under the relevant laws of Nigeria. Can I get the next slide, please? So the scope of the rules, and we have the next slide. So the scope of the rules covers the domestic law, and we have the tax treaties, and the content of the domestic law and the tax treaties has been explained in an information circular issued by the service. And the information circular can be accessed or can be downloaded from FRS website as provided here in this presentation, www.frs.gov.ng/tax circulars-regulations and public notices. So if you click on that website, you are able to download the circular that have been issued by the service to explain the procedures for the taxation. Next slide, please. So, however, here I will quickly explain some of the provisions or content of that circular, which is explaining the domestic laws. Next slide. Now, I will start with the domestic rules. And the domestic rules starts from our section 9 of the company's income tax. And of course, I will also explain section 13, 14, section of CETA, and section 24F of the CGTA, that's capital gain tax, as they affect the taxation of that business. So section 9 of CETA made it clear that an income that is taxable in Nigeria, and it says the income that is derived from brought into, received in, and accruing in Nigeria. So when an income is accruing in or derived from, brought into, or received in Nigeria, irrespective of the nature of business or nature of activity, it will be taxable in Nigeria. So the shipping business or the airline business, as long as their income is derived from Nigeria, it is subject to tax in Nigeria. Then under section 13.1, it talks about the income of Nigeria that is taxable. So in essence, we are going to be looking at the fact that under the shipping business, the taxation can be broadly classified into two: the domestic business and the foreign business. What I mean is the business being operated or owned or run by a Nigerian company. So if it's a Nigerian company that is engaged in the shipping or airline business, the law or the provision of the law applicable to them is different from when it is the foreign entities or foreign company that is engaged in that business and deriving income from Nigeria. So for Nigerian company deriving profits from shipping or airline business, section 13.1 we apply. And what does section 13.1 says? Section 13.1 says the profits of a Nigerian company is taxable wherever, taxable in Nigeria, wherever that income is made or derived from, whether brought to Nigeria or not. So if, for example, any of our shipping company or airline company, for example, our airpiece. So if our airpiece derive income, whether from operating international routes or local routes, or from even operating a local business abroad. As long as it's a Nigerian company, airpiece, then the profit from all those activities will be taxable in Nigeria. That is for Nigerian company. Then if it is a foreign company can also operate domestic routes. So I finished with domestic companies, airline or shipping. Now for foreign airline or shipping. Foreign airline shipping can operate in international traffic, or it can operate domestic route of Nigeria. For example, some of us who have entered a local flight recently, and you will see some foreign airlines operating the route of the route in Nigeria. For example, I've entered some planes from Lagos to Abuja, and I discovered that it wasn't a Nigerian company. Yes, the ticket and everything was in the name of Nigerian company, but if you enter the plane, or the name there, the uniform of the attendant and so on, you discover that it's not a Nigerian entity that owns or that's operating that route. So if that the income that is from that activity is fully taxable in Nigeria, because that is that entity has more or less a fixed base in Nigeria under Section 13(2)(a) of CETA. And if such fixed base is in Nigeria, then the income from that activity or from that operation is fully taxable in Nigeria. Then the second class of foreign companies operating in Nigeria is those operating purely international traffic. That is, they are not operating the domestic route of Nigeria. They come, they carry passenger from abroad, they bring it to Nigeria, and they carry passenger from Nigeria, they take it out, either passenger goods or maize or livestock. And the activity of such enterprise will be covered under Section 14 of the Companies Income Tax Act. And under that provision, what is the sourcing rule? The source or the income that has a source in Nigeria under Section 14 is carriage of maize passengers goods from Nigeria. So if, for example, let's just use an example, maybe Air France. If Air France bring passenger from Paris to Nigeria, the income from that activity is not taxable in Nigeria. But where Air France carry passengers or goods from Nigeria to Paris or to anywhere, that income will be taxable in Nigeria. Now, if such enterprise, foreign enterprise, carry on what we call international traffic in Nigeria, then it can have two classes of income. It can have freight income, and it can likely have non-freight income. What is freight income? Freight income is income that is generated from carriage of passengers, maize, livestock, or goods. Whereas non-freight is other incidental income that is not from carriage of person. For instance, you can have instances where they rent out containers or they let out containers. Such form of leasing will not constitute freight income. They can also have a scenario where they have what we call bareboat charter. That's lease of vessel on bareboat basis. In that instance, it will not come under international traffic. In fact, it will come under Section 79 of CETA, which cover rent, and that section defines what is rental income. And it specifically says rental income definition includes income from charter of vessels. So if an aircraft, foreign airline lease an aircraft to Nigeria, then it will not come under Section 14. Rather, it will come under Section 79 under the definition of rental income. Then, if we go back to the freight income, if a foreign aircraft or a foreign airline or shipping company derived income from carriage of passengers, mails, or goods, that is their freight income, how will it be subject to tax? Section 14.2 describes how to subject such profit to taxation, and it's described two concepts: the adjusted profit ratio and the depreciation ratio. That is the ratio of allowance by way of depreciation. And for the purpose of taxation, the adjusted profit ratio will just be a portion of the adjusted profit of the company that is attributable to Nigeria. And the depreciation ratio, of course, is the portion of depreciation that is attributable to the Nigerian operation. And when you have your adjusted profit and you remove your depreciation or capital allowance, what you have is your total profit for the purpose of application of your tax rate, which is 30% tax rate Nigeria. So ordinarily, if a foreign airline or shipping company derived profit from that freight income from Nigeria, it will be subject to tax using the adjusted profit ratio and depreciation ratio as described under Section 14.2 of CETA. However, not in all cases. The law gave some conditions. That's Section 14. If you move to Section 14.3, it gave some conditions where we can apply Section 14.2. And those conditions are two. One, it says the tax authority of its home country computes and assesses tax on a basis not materially different from CETA. So, sorry, just for simplification, let me go back to the example of Air France. I only use Air France just for the purpose of clarification. So let me quickly go back to that example. If, for example, Air France is a French airline, and in that instance, Section 14.2 will be applicable if, number one, France computes and assess taxes on the basis that is similar to what we have, or that is not materially different from what we have under CETA. It will also be applicable if the company, which is Air France, now bring in their certificate, that is certificate of their depreciation ratio and the adjusted profit ratio. So that certificate must be brought to Nigeria, certified by their home country tax authority to say this is the depreciation of the entity and this is the profit or the adjusted profit of the entity. So if those two conditions are present, then we can use Section 14.2. However, if those two conditions are not satisfied, then we move to the next stage, which is Section 14.3 of CETA. Section 14.3 empowers or oblige FRS to use a fair percentage to assess that entity to tax. So now this is slightly different, I mean, in nomenclature from what we have under Section 30. Section 30 says fair and reasonable percentage. However, Section 14.3 says fair percentage without the word reasonable. However, based on the policy of FRS for some years now, what is considered fair is our fair percentage has been 6%, which is your 6%. Now, Section 14.4 describes the application of minimum tax. And it says that where, for any reason, the tax computed using either Section 14.2 or of the earning that's turned over from Nigeria, it says the tax to be charged should be, that's the minimum tax, should be 2% of that carriage or income from carriage from Nigeria. Now, in defining the income under that minimum tax, it says full amount collected. So because we've had instances where some entities believe that they have to deduct, they have to have some deduction before they arrive at the amount that the tax rate will be applied on. But the clear provision of the law is the total amount collected. So they said. Then I also need to clarify that this minimum tax, just like other minimum tax provision in the law, is not the primary rule. This minimum tax will only apply where tax computed using the other rules are less than the minimum tax. Because we have had some instances where we have had some company arguing that, the service should levy them just 2%. However, we need to be clear on the provision of the law. The provision of the law is that it is a minimum tax, which is applicable only where tax computed using the other rules are or is lower than the 2% on the turnover. So that is for the freight income. Then for the non-freight income, section 14.5 says that non-freight income shall not be subject to tax under section 14. Then if it's not subject to tax under section 14, then it's subject to tax under the other rules of CETA.
Please help us round up. Sir, 2 minutes so that we can.
So
thank you, sir.
Now, when we are talking of under the other rules of CETA, we are talking of our withholding tax rate under section 79 for rental income. So if it is leasing of containers, leasing of vessels, is the respective withholding tax we apply. If it is for services, of course, we also see the respective withholding tax under the relevant withholding tax regulations. And importantly, the fact that the taxpayer will still need to file returns. Whether it is for freight income or non-freight income, the taxpayer is expected to file return. Another thing I need to be clear on is the issue of demurrage. The fact that, what is demurrage? Demurrage is when you rent a container or any of the equipment used and in the shipping or in the maritime industry or in the airline industry, and is exceeded the number of days that it should cover. So what to pay on top is the demurrage. So that cannot also come under freight income. Rather, it will come under the non-freight income. Quickly, as I'm rounding up, next slide, I need to quickly talk about the treaty situation. Earlier, I was giving the example of France, Air France, so that I don't leave the audience confused. I only use Air France as just an example. What I've described above will not be applicable under treaty situation, where there is tax treaty between Nigeria and another country. The provision of that treaty will apply. And under the tax treaty, the rule governing the taxation is called international traffic. It has a separate article under the tax treaty. In most tax treaties, it's Article 8. And the scope of international traffic is defined under Article 3, under the definition section. And the scope of international traffic is also for carriage, and also does not include domestic routes. So when you operate, when a foreign company operate domestic domestic routes, it is not covered under international traffic. For example, let me go back to Air France. Assuming Air France operates from the Lagos and Abuja routes, despite the fact that we have tax treaty with France, that income from that route will not be covered under the treaty, under international traffic, under the treaty. Rather, it will be covered under the article of business profit, which is Article 7. And before you can tax under business profit, of course, you need what you call permanent establishment under Article 5. But of course, for an airline to be operating the routes in Nigeria, of course, that airline will have a permanent establishment in Nigeria. So that airline will be subject to tax. For that domestic route, will be subject to tax under Article 7, which is business profit, and not under Article 8, which is international traffic. Then quickly, the issue of reciprocity. Now, in most tax treaties, of course, or if you go to the model, it talks about the income being subject to tax only in the resident state. However, under the tax treaties of Nigeria, we have a special paragraph, Article 8, in Article 8, which is paragraph 2, which says that where there's no reciprocity in international traffic between Nigeria and the treaty partner, then Nigeria have some level of source state taxation. So in essence, if under the treaty there is that provision, then if those airlines from those countries or ship from those countries come to Nigeria to carry passengers or goods or livestock or meat, and they derive income, but no Nigerian airline go to the other country to derive income, then Nigeria will have the power to subject that airline from the treaty country to tax. However, the provision of the treaty.
Sorry, I have to cut in here. We are short. Sorry to cut you. Sorry, I made a mistake. I was supposed to allow the captain to make his presentation before yours, and so we are to bring him in now. His presentation is very short. He's supposed to lay the foundation of the aviation industry too. Sorry, Captain Oshutoku, I'm sorry for skipping you. Please, you have the floor now, sir. Mr. Kalishoma, you still have the time to clarify whatever you've just said during the Q&A session. Captain, you have the floor. Sorry for passing on you.
It's okay. Good morning, everybody on the forum. I probably just have about 6 minutes to go into another meeting. And I've heard everything. I'm happy I even heard the last gentleman speak. He talked about taxation as it affected the aviation industry. But it's the obligations that we're looking at here for the airline operators who are the stakeholders in aviation, and then the issues that are affecting compliance in the aviation sector or industry. We all know what the obligations are. What we're looking at here is how are we able to comply with the tax payments as it comes to us. The question or the problem, or will you say the challenges, are the things we should look at affecting compliance. And we also have to look at this fact: when every government sets up a tax system to pick up tax, the government also encourages or provides an encouragement platform for those airlines or for those companies to grow. If there's no growth, there will be no taxation. Now, we're looking at things where the tax system here determines that everybody is in the business, they're making money, but how are they making the money? Okay, we should be looking at the sustainability of aviation in Nigeria, and we'll look at some factors. No gainsaying that the government has done quite a few good things, but we need to ask the government to help us, please do more. Let's look at the fact that every other place you go for aviation in the world, the government gives them some kind of backup for sustainability. And the backup is not in terms of money, it's just in terms of the facilities. Here, we don't make aircrafts in Nigeria, but we need spare parts to be zero tax, zero duty on them, and zero tax, which the government has done. We do not pay duties for customs for spare parts imported to fix these airplanes. But we have a scenario on ground. The parts come in. Once we have paid heavily, yearly, airlines pay heavily to companies that provide spare parts within 24 to 72 hours, and they designate it AOG, it means aircraft on ground. Every port such packages go into, release the packages to the airliners within 24 to 36 hours. In this country, it will stay in the customs strong room, remain there for days. Most of the airlines in this country we know lease airplanes. Airplanes, when they are parked on ground, they are losing money. You look at an airplane that is a minimum lease, whether he flies or not, that's how these aircrafts come. Let's take a minimum of $2,000, which you wouldn't find for lease per hour. For 7 hours of flight a day, that's $14,000. And this aircraft sits on ground for 5 to 6, 7 days, waiting for the goods to be cleared from customs, goods that don't have customs duty on them. We're talking about $84,000. We've not talked about the crew, which are expensive to keep crew, engineers, dispatch officers, sitting on ground for 1 week doing nothing. Look at their costs. So if we look at such overheads, how do airlines actually comply with tax obligations? I leave that. I take a second one. We know we have what is called the BASA, Bilateral Air Services Agreement. It's normally what is an air service agreement between two countries that provides different degrees of freedom of air passage movement between both parts of the countries. And we must also know that bilateral air service agreement is a process of sharing frequencies of flights between two countries. Here in Nigeria, it's an allocation. Let's look at what I mean by allocation. The entire European Union has 43 frequencies weekly into Nigeria. 43 frequencies weekly into Nigeria. How many does Nigeria have into EU? The answer is 0. Central Bank keeps saying that they have so much money in dollars that they are owing to pay back to those countries. Why don't we develop a system that will enable Nigerian operators to operate back as well into those countries, and also bring back foreign exchange through Central Bank and reduce the strain for Central Bank? As if that is not enough, let's look at our domestic scenarios here, how this unbalanced equation of sharing or allocation of frequencies has affected us. Scores of years back, we used to have British Airways, KLM, and all these other airlines share code domestic with the countries. Domestic with the countries they have. All right, meaning that if I'm coming to take passengers out of Enugu or out of Kano or out of any part of Nigeria, those passengers will fly those domestic airlines into Lagos or Abuja. Okay? Means the domestic airlines have funds, have profits into their accounts. Now they fly empty seats. Why? Because we have airlines like Ethiopia flying into Lagos, flying into Abuja, flying into Kano, flying into Enugu to take these passengers out. And I tell you what, even if it is a Nigerian airline today to fly, there's only one airport in Ethiopia that is viable, Bowl. You look at Emirates, 21 weekly flights, 14 to Lagos and 7 to Abuja. When our only viable airline went there, so far that is the only viable one, Air Peace, they threw them away to the cargo airport, Sharjah, which gives their operational values higher at low cost of operation. It took the wonderful Minister of Aviation that we have, God bless him, to step down with his own crew in the Civil Aviation Authority to say, hey, guys, you must do something, otherwise don't come here. And what happened? The same country or people that said they didn't have slots for Air Peace found 7 slots all of a sudden overnight. What we're saying is that the government has to put their feet down to ensure that aviation is growing and is sustainable. I'm only probably stopping at these 2 now because of time that I have. But I tell you what, the only thriving company in Ethiopia is Ethiopian Airlines. It's keeping the economy of that country standing. Find out. Why? Because the government 100% took it over and is shooting for it, making sure that it gets what it wants to make it stable and to sustain it. Ethiopian Airlines, I bet, is paying lots of tax. Ethiopian Airlines is felt everywhere in Africa, from the Horn of Africa where they're coming from. So we need to look at factors, things that are bringing the airlines down. Finance processes, the BASA agreements are not balanced, duty for customs that we know we already have from the federal government of Nigeria, but then of course it takes us days before those parts get to the airlines. At this point, I am going to stop. That's all I have for today. And then if you want me to do you a write-up on what I've said today, I will do that and send straight back to you. And thank you very much, everybody. But I just have to go. God bless us. Bye-bye.
Okay, thank you. Hello, can you hear me? Hello? Hello, can you hear me? Hello? Okay, thank you very much. Thank you, Captain, for that wonderful insight. It's also part of what we have been speaking about, lack of reciprocity. It also hinders tax treaty benefits to Nigeria. And right now, we'll be calling on the next person to make the presentation. We have Mr. Kennedy having made presentation on the policy angle, what made up the obligation, what made up the taxation of the industry. We'll be bringing in somebody from the domestic wing. The person will be speaking on the obligation from the domestic angle, on the obligation of the players in the industry. I will be bringing on Mrs. Olufunke Williams, who is the tax controller in the FRS in charge of shipping and aviation. Mrs. Olufunke Williams, you have to stop. Thank you very much.
Thank you. Thank you. Good morning. Hello.
You are on. Good morning,
okay.
Continue.
Good morning, sir. Permit me to stand on the existing protocol. I'm William Olufunke, the tax controller, Light Tax Office, Aviation, Shipping, etc. So I'll be looking at the topic of today from the angle of the implication of the Finance Act as it borders on maritime and aviation industry. The Finance Act was enacted by the National Assembly of the Federal Republic of Nigeria to actually amend 8 legislation, namely CIT, Value Added, Custom and Excise Tariff, Personal Income Tax, Capital Gain Tax, Stamp Duties, Petroleum Profit Tax. And so, as it affects the maritime and the aviation industry, 3 major legislations I will be discussing, and they are CIT, Company Income Tax, Value Added Tax, and the Capital Gain Tax. I deal with the Nigerian company, and so I would like to mention briefly what a Nigerian company is. A Nigerian company is a company whose control and management of its activities are exercised in Nigeria. The income of a company which has been registered under the law of Nigeria to operate in maritime and aviation sector is therefore subjected to CIT. Based on the provision of Finance Act amending the CIT Act, CIT shall each year of assessment be payable at the rate specified in Section 40 upon the profit of any maritime company or aviation company which are accrued in, derived from, brought into, or received in Nigeria, and which are not subject to tax under the Capital Gain Tax Act or the Petroleum Profit Act and Personal Income Tax. From the above, income derived from services provided and businesses engaged in a maritime company is subject to charge of CIT under CETA, including the sales and hire of vessels, transportation of cargoes and persons, and other ship operation services. Let me quickly mention tax identification number. Every company involved in maritime-related activities and aviation are mandated to have a tax identification number, which shall be displayed by the company on all its business transactions with other companies and individuals, and on every document, statement, returns, audited account, and correspondence with revenue authority, including Federal Inland Revenue Services, ministries, and all government agencies. In fact, seen by virtue of the provision of Finance Act, has been made a precondition for the opening of a bank account. In case of an account already opened within 3 months of passage of the Finance Act, Maritime and Aviation Company shall be required to provide their TIN as a precondition for the continued operation of their bank accounts. Profit of a company from certain dividend. The Finance Act excludes the provision of Section 19 of CETA from applying to dividend paid out of the retained earning of a company, provided that the dividends are paid out of profit that have been subjected to tax under CETA, PIT, or CGT. However, there are certain profits that are exempted from tax. The profit of a small maritime company in a relevant year of assessment are exempted from taxation. However, this does not exempt such company from complying with tax regulation requirements and filing of its tax returns. A small maritime company is nevertheless subjected to provision of CETA as regards the time of filing, penalty for breach of statutory duties, and all other provisions of the Act during the period in which its profits are below the tax-paying threshold. A small maritime company is defined as a company that earns gross turnover of 25 million naira or less. However, I don't think this will apply to aviation companies. I doubt if there are any small aviation companies. Let me quickly talk about deductions allowed. The Finance Act amends the provision of CETA relating to the deduction allowed for purpose of ascertaining the profit or loss of any company for any period and from any source chargeable to tax. Thus, where a company is involved in the provision of maritime and aviation service in Nigeria, in determining its profit chargeable to tax, there shall be deducted all expenses for that period that are wholly, exclusively, necessarily, and reasonably incurred in the production of those profit chargeable to tax. These deductions shall include any sum payable by way of interest on debt borrowed and employed as capital in acquiring the profit of the company, and compensating payments which qualify as interest under Section 9 of CETA, made by a lender to his approved agent or borrower in a regulated security lending. Also, there are deductions not allowed. The Finance Act amends the provision of Section 27 of CETA by replacing certain clauses and adding others. Pursuant to the provision of the Finance Act, no deduction shall be allowed for the purpose of ascertaining the profit of a maritime or aviation company in respect of the following: A. Any expense whatsoever incurred within or outside Nigeria involving related parties as defined under the transfer pricing regulations, except to the extent that it is inconsistent with the transfer pricing regulation. B. Any expense incurred in deriving tax-exempt income, losses of a capital nature, and any expense allowable as a deduction under Capital Gain Tax Act for the purpose of determining chargeable gain. C. Any penalty prescribed by any act of the National Assembly for violation of any status. D. Any tax or penalty borne by a company on behalf of another person. Related parties are defined under transfer pricing regulation as a relationship between persons where one person has the ability to control or influence the other person in making financial, commercial, or operational decisions. Therefore, while expenses are generally allowable deductions when computing assessable profit, where they are incurred as part of a related party transaction or as part of deriving any tax-exempt income, or they are the result of any penalty, they shall not be deducted from assessable profit of a maritime company or an aviation company. Payment of minimum tax. The amended to CETA now prescribe a new minimum tax to be levied on companies that operate in these industries, where in any year of assessment, profit from all sources of such company result in a loss, or where the company ascertained total profit result in no tax payable, or tax payable is less than minimum tax. In this scenario, the minimum tax to be levied and paid shall be 0.5% of gross turnover of the company, less frank investment. Where a maritime company earn a gross turnover of less than 25 million, such company is exempt from paying minimum tax. Rate of tax. Let me equally mention the rate of tax that is applicable to the medium company and the large companies. The Finance Act amends CETA as prescribed a new rate of tax. If the maritime company is classified as medium-sized company, tax shall be levied on the profit of such company for each year of assessment at the rate of 20 kobo for every naira. I mean 20% assessable profit. Where the maritime company is classified as a large company, tax shall be levied on the profit of such company at the rate of 30 kobo for every naira. That is 30% of assessable profit. A medium-sized maritime company is a company whose turnover is above 25 million, but not more than 100 million. Time within which tax is to be paid. Every maritime and aviation company is now required to make payment of tax on or before the due date of filing, in one lump sum or on installment, provided that the final installment must be paid on or before the due date. Remember, at the beginning of this discussion, I said 3 major legislations were affected. Let me quickly move to the value-added tax as it is affected. Value-added tax is a tax on spending borne by final consumer of goods and services, but it's included because it is included in the price paid for the goods. It is regarded as a consumption tax. VAT in Nigeria on their transactions. The rate of VAT. VAT from the commencement of Finance Act be computed at the rate of 7.5% of values of all taxable goods and services. This is an increase of 2.5% from the former rate of 5%. VAT exemptions. I said it earlier that there are some exemptions in the Finance Act. The Act introduced a specific exemption for commercial aircrafts, commercial aircraft engines, commercial aircraft spare parts, and airline tickets issued and sold by commercial airline registered in Nigeria.
Sorry, ma'am. Thank you very much. I may have to cut you at this point. We will have to move on. I will give you more time. And when we give you more time, ma'am, we'll be asking specific questions about what the obligation of those persons is in your office, ma'am. And at this point, We would like you to pause at this point while we will bring in some other speakers. We are going to give you more time before we finish. Thank you very much, Ma. I would like to call on the next speaker at this point. We are moving from corporate, and now we are coming down to individuals now. Mr. Kaji Shamavin laid the foundation for taxation of the industry, both from the corporate and perspective and the individual. Now we are driving down to the obligations of individual and what the individuals need to know in the industry, individual operating in that industry. We'll be bringing the tax controller in charge of the non-resident tax office. These are individuals and even those who are outside Nigeria, whether individual or not. So we'll be bringing in Mr. Al-Aji Abdullah Aliyu to come up. He's a tax controller in charge of FRS non Mr. Ali, you have the floor.
Okay. Thank you, Mr. Femi. May I stand on the existing protocol? And I don't know, do you have my slide, or I should share it from here? Okay. But it seems Mr. Kajeshomo has made substantial presentation of part of my slide. But notwithstanding, what I'm just asking for, you can permit me if I repeat some words which you have already mentioned. I'm the tax controller of non-resident person tax office. Non-resident companies are companies that are not incorporated in Nigeria. And we know all the international air and international shipping lines are companies that are not incorporated in Nigeria, but they are driving income in Nigeria. So we have the same taxation guidelines that are guiding the domestic. We still have that of that is guiding the foreign companies as enumerated by the tax policy man. So can you please go to the next slide? Go to slide 4, because 4. Thank you. The shipping sector is a complicated and a mafia sector. They are not regulated. But the air and aviation, they are regulated by IATA, which improve the compliance levels of those companies. They all have, in shipping line, you have what we call either the dried cargo or weight cargoes. Dried are the containerized, and then the weight cargoes that are lifting crude oil. While in air, you still have that of passenger and cargoes, and at the same time, you have the leasings. And as was mentioned earlier too, we understand Nigeria is an import-dependent country, of which these people have contributed about 1.6% of our GDP as presented earlier. Go to the next slide. Next slide, please. Next slide. These have already been taken care by Kajeshima. Next slide. Okay, fine. I want to concentrate on compliance because most of the legislation have been taken up by Mr. Kajeshima. The first compliance that the taxpayer needs is for registration. A non-resident company, including shipping and air, is easy and seamless for it to get registered with Nigerian Tax Authority. What you need, you have an option. Either you go through, you can register online by logging onto the tax formats, https taxformats.frs.government.ng. Or you can send a mail to the tax office. We have a dedicated email address, nrptax@itd.frs.government.ng. Or at the same time, you have an option to send a written application, which is normally obtained in other tax offices. So just simply to say that the registration of non-resident is more digital now than the domestic taxpayers. Then when you do this on any of these platforms, you'll be able to generate the tax identification number for you and update you on the tax formats portals concurrently. Then you'll be able to get the login details for them to file. So the taxpayers, the international air, the shipping, they can get the login detail, they can file anywhere in the world. So the first level of compliance, we provide it at the non-resident person tax office seamlessly. So go to the next slide, please. Next one. The only thing here that I want to make a comment, sorry, just the other one. So I just want to make a comment on subsection 2, where if the country preparing on the same basis or not material different with Nigeria, we used to have that challenge from the taxpayers. Some of them are coming from those countries that we don't have similar. So we are now left with the two options, either fair and reasonable, which we always argue with them, or the minimum tax. So that's the only comment I want to make on this section. Go to the next slide. Next slide, please. I don't want to repeat that one. I've already been taken by Kadeshima. Well, he have dwelled much on these tax treaties. The only thing I want to mention, which the other speaker from Aviation have said, in treaty, wherever you have a tax treaty, domestic laws superseded. So Section 45 overlap. Once you have a tax treaty, Article 8 or Article 7 will take precedence. But there are conditions of reciprocity. We have instances here whereby the BASA agreement, which the other presenter talked about, some companies are using it as a reciprocity. So we have issues with those companies, of which is a practice. Some of them are seeing that by the time they share the frequency, it serves as a reciprocity. But the fact is that this does not mean it's a reciprocity. So BASA agreement is a commercial agreement. This does not give a taxpayer that you have a reciprocity with Nigeria so that you can obtain a lower tax rate or zero tax rate for that one. And treaty shopping too. We understand some companies are coming from different jurisdictions that we didn't have tax treaty with them, but there are guidelines, of course, for you to claim treaty benefit, of which in most cases you have to provide a certificate of residency for you to enjoy the treaty benefit. So we have that experience in tax office. So what I want the stakeholders to understand that BASA does not constitute a reciprocity, and treaty shopping is for you to enjoy the treaty. There is a criteria for you to fulfill by providing the certificate of residency for you to enjoy that one. Next slide, please. Fine. For compliance in filing company income tax, Section 14 make provisions of how the income of shipping and air are going to be taxed, while Section 55 are making provision of what to file, particularly 55(1)A for non-resident to file, whereby you need to compute your capital allowance, fixed asset schedule, tax computation with self-assessment returns. So being a specialized taxation of shipping, which is different with normal companies, we have redesigned a tax ProMax as the platform for filing returns. We have redesigned a tax ProMax now to accommodate the provision of Section 14. All the criteria of Section 14, subsection 2, subsection 3, subsection 4, 5 have already been designed and accommodated on the tax ProMax. So companies, they can now file, because you have that issue when we started last year, that shipping and air did not file when the normal companies are filing. We have already taken care of that one. They can now file on the tax ProMax. At the same time, for those companies that are coming from treaty companies, it also accommodates the provision of Article 8. So what you need, if you are from a treaty country, just choose the country you are coming from. The provision is there on the tax ProMax. So once you have that provision, so you have taken it, then automatically the provision of the treaty, Article 8, will be reflected on your returns. So filing returns is done through tax ProMax, because initially when you generated your tax identification, you updated the tax ProMax, you will get your login details. Use that one to file your tax returns. And then even either you are coming from a treaty country, that one have taken care of that one. Then payment. Payment is possible for local currency. You can make payment through the tax formats. But when you are having a foreign currency transaction, of which most of them do have, so that foreign currency is made through the JP Morgan banks. And then only 3 currencies are recognized, the USD, the Euro, and then the GP. While the monthly remittances are recognized because those selling tickets based on IATA and then the requirement, you cannot remit your for some ticket sales except when you make taxes. So the monthly remittances, which is part of our requirement in one of our cycles, that we should be companies engaged in air and TV should be making remittances on monthly basis. So those remittances that are considered as payment on account until when the taxpayer finally files its tax returns. So the provision for filing company income tax is now seamless on tax formats. The non-resident company can just file it either of this one, either on monthly basis, you can file pay on account, or on annual basis. This provision of Section 14 have been taken care of on that one. So next slide. So the next slide is on issue of VAT. VAT applied on the local income. On the freight, VAT does not, but on the local income of demurrage, commission, container damage, and other things, VAT applied. And taxpayers, based on the login detail you have, you need to log on monthly basis, file your tax returns. For companies that are in air, international air, most of the things they don't, based on experience, they don't have VAT. But the tax format is designed in such a way that you have that VAT from a monthly basis. What you are advised to is file nil if you don't have a vatable transaction. If not, the system will just be committing penalties for you. So for Naira, the local currency, file and tax formats, pay on tax formats. You have an option either you can pay direct or you can generate a PIN or DIN and go and make a payment. While you have a foreign currency VAT, that one, the model is not yet on the tax formats. What you need to do the normal manual filing of Form 002A to the tax office. And the payment also, you can make the payment through the JP Morgan I said earlier. But don't file foreign currency on tax formats. If you do that one, it will create a liability for you. And then you will be having penalty and interest, because based on experience, you used to see some of them that are filing those foreign currency on the tax format. Don't file foreign currency on tax format. The model is not there. What you need, file nil for foreign currency and then file the hard copy to the tax office. So go to the next slide.
Thank you. Alaji Ali, before you go to the next slide, I would like to hold your thoughts here. We're
Okay.
sorry, we need to, I'm getting a call from the back end. Need to bring in our next speaker first. Then we'll give you the floor to speak after now. Sorry, we need to pause for now, bring in our next speaker. Then we will now. So our next speaker is from the Lagos Internal Revenue Service. Is supposed to give us the obligation. We know that the aviation and the shipping industry is concentrated in the Lagos state, and they have some obligation under the states. I would like to bring in our next speaker from the LIRS to speak to us. You can come in now, sir. Thank you, Mr. Oshuntoku.
Okay. Good morning, everybody. It's the morning, yes. I'm not sure the audience that I'm speaking to, but let me just stand on existing protocols. From the LIS perspective, we deal mainly with PETA. So, and then, for individuals, you either under pay as you earn, PE, or direct assessments. So, with the Finance Act 2020, it provides that all income be taxed. So gross income must be taxed, means income from all sources, less all non-taxable income. Non-taxable income include national, what you contribute to the National Housing Fund, NHF, the National Insurance Scheme, NHIS, National Pension, Life Assurance Premium gratuities. So every individual that resides in Lagos State, or any state for that matter, is expected to file with the relevant tax authority all their global income from all sources to the relevant tax authority on or before the 1st of January of every year. If you don't do this, you'll be contravening the law, and as an individual, you would be fined 50,000. If you are an employee, your employers are meant to file on your behalf, and so your employers will file before the 31st of January of every year. An individual should file, so like professionals should file by the 31st of March. So beginning from January all the way through to the 31st of March, all individuals are meant to file. As I said, if that is contravened, individuals will be expected to pay a fine of 50,000. Where companies should have filed on behalf of their employees and they don't file by the 31st of January, if found guilty of not filing, they would be expected to pay a fine of 50,000. I might need to just touch on what the pension contribution is, the National Housing Fund contribution is. We also have Industrial Training Fund, which is also exempted. So on pension, it's 8%. It used to be, before the amendment on the PTAM, it used to be 7.5, but it's now 8% of basic housing and transport. National Housing Fund, which is an allowable relief, is 2% of actual basic salary. And then there's also an allowance for Industrial Training Fund, which is 1% of total payroll cost. Before employees are taxed, there's what we call a CRA, Consolidated Relief Allowance. This is the hire of 200,000 or 1% of gross income. I'm not sure that I need to define what gross income is, but gross income is all income from all sources, as I said, less all non-taxable income. I've already touched on what some of these non-taxable incomes are. So gross CRA is the hire of 200,000 or 1% of gross income plus 20% of gross income. This means that before tax can be applied, or before taxation, this consolidated relief allowance would have been allowed. Before now, there were different types of reliefs, including child dependent. All of that is now rolled into this consolidated relief allowance. It means that employees will no longer enjoy the additional 20% relief previously claimed on the portion of their income that relates to what I said, the NHF, pension contribution, and other tax-exempt items. This is the case because you deduct this from your gross income before you apply the CRA. All for payee, all deductions are meant to be paid by the 10th day of every month. This goes on right through the year, and then at the end of the year, the employer files the returns, which I said has to be filed by the 31st of January, I'm sorry. And where you self-employed, a professional, has to be filed by the 31st of March. This filing, LI has made it easier by asking it to be filed electronically. So we have an e-filing service. We have a portal called eTax. The portal enables taxpayers to file their returns electronically and can interact online with I'm sorry. I'm going to have to stop there. I have an appointment and I have a taxi waiting for me. I'm so sorry. I'd previously warned that this may happen. Hello? Hello?
Yeah, thank you very much, sir. We quite appreciate.
Yeah,
Thank you. We are with you, sir.
Yeah. I'd previously warned. I have to go. I'm so sorry.
No problem. We understand that, sir. Thank you very much for your presentation. We understand.
Yes.
And
Yes.
thank you for that which you have reeled out to us. I'm
Yes.
sure where there's more,
Yeah.
I'm sure where there's more, we will have the questions answered. Thank you very much. We
Thank you.
appreciate your time as we'll be moving on. Thank you very much. So thank you, viewers, for staying tuned to this program. We're still talking about this Taxpayers Delight, and it is a taxpayer webinar series to educate taxpayers on their obligation. And today we are, as we've been having since, we have the array of panelists from the FIRS, the LIRS, and the industry. So right now we'll be returning to some of our panelists. We'll be asking some questions. If taxpayers have questions from the if participants have questions, we'll be answering them at this time. But before we start asking questions, I'd like to call on Mr. Abdullah Aliyu to quickly complete his presentation in 5 minutes. Alhaji Aliyu, please, you have 5 minutes to complete your presentation. Thank you very much.
Okay, thank you, sir, for the opportunity. Yeah, and then another thing in it we have on the taxation of non-resident is the tax clearance certificate. A part of the normal annual TCC, we have what we call fund remittance certificate. This is in line with the provision of section 101 subsection 4. For you to move your fund outside Nigeria, you need a clearance certificate. So we provided that one for all the non-residents that are repatriating their funds. It's available for us. Okay, go to next slide, please. Next slide. Taxpayers that are in international traffic, okay, air and shipping, in event of dispute, they have an option. They can go through the normal TAT and then they'll go through TAT, High Court, and whatever it is. But for those that are coming from treaty, they have an option. They can use the mutual agreement procedure based on the provision of Article 25 of Model Tax Conventions. So because you have that instances that there are some taxpayers that we had, then initially they went to TAT, but eventually when they understand that, oh, they're from treaty country, they want to exhaust that opportunity, they pick it. But it's at the option of the taxpayer. If you feel like you can use the normal TAT procedure and go fine and good. So the next slide. Well, for effort made by the service to encourage compliance by the non-resident company, because we understand shipping lines that are particularly in weight cargoes operations, those that are lifting crude oil, we have a very low compliance level in that one in particular. But for air, with the IATA, which is a regulatory body internationally, it has improved the compliance level of companies in air. So the service have done a lot in order to encourage compliance by these non-resident companies. Truth, one, created a dedicated non-resident person tax office to handle the tax of non-resident taxpayers, of which that what they are doing by mail, by phone call, whatever we satisfy the taxpayers of non-resident from other jurisdictions. And then on continuous taxpayer education enlightenment through the robust and dedicated FIRS contact center, that one taxpayers can call at any time on the issues, and then they will be referred to subject experts for them to assist them. FIRS have also issued public notices on tax resident companies. And the major one is enhancing collaboration with relevant government regulators. So we have gone a lot in establishing a close collaboration with NIMASA, with MPA, with NCCA, with Nigerian Customs Services for exchange of information in order to enhance the compliance of the non-resident companies, and through the normal review of tax laws to align with the global best practice. So this the few things that I have for my presentation. Go to the next. Thank you. Next slide.
Thank you very much. Thank you very much, Paul, for your presentation. It's very enriching, and I know there are questions already coming in. I would like to come back to Mr. Kajeshomo for a brief. We would like to give you the next 5 minutes. Next 5 minutes. And while you're making your presentation, there's a question here for you, Mr. Kajeshomo. There's a taxpayer who have sent in this question. He said, how is minimum tax computed under international traffic? That is airline shipping and telecommunication. I'm sure you spoke about it. Madam Williams spoke about it, and I'm sure Alhaji Ali also spoke about it. But as you conclude your presentation, I would like to answer this question. Thank you. Mr. Kajeshomo, you have the floor, please.
Thank you, Mr. Larinde. So quickly, I will start my presentation, the conclusion part of my presentation, by thanking Mr. Captain Kenneth for his presentation and attempt to provide response. And I think by that, I'll be able to also present the remaining part of my presentation. And importantly, he spoke about the fact that we need to grow the airline and the shipping industry in Nigeria, the aviation and the maritime industry in Nigeria. That before you can be talking about collecting taxes, income must have been made. And it's on that basis I agree with him, and I also say that in the law, there is sufficient, there are incentives. I don't know how sufficient they are, but we have incentives to grow the domestic business as contained in the relevant provisions of the law. And the first one I will speak about is the fact of Section 14. As I explained earlier, Section 14 is specific to international traffic. It's specific to foreign airlines deriving income from Nigeria. For domestic airlines, they are not subject to tax under Section 14. So what that means is that the 2% minimum tax I spoke about earlier does not apply to domestic airlines that carried on, airlines that are resident in Nigeria, that carry on business, whether domestic or international traffic. They are not subject to tax under Section 14, but they are subject to tax like any other companies in Nigeria. And what that means is that they are, apart from the issue of minimum tax under Section 33, they are only taxed based on profits. So it's only when you make profit that you are subject to tax. So the essence of taxation is not to discourage businesses. You make the profit, is after you have, the income, you deduct all your expenses, you have profit. So it's out of that profit that government is going to take its share. The second issue I will also speak about is the treaty provisions. Now, I mentioned the issue of reciprocity under the tax treaties, and I agree with him on the issue of airpiece he discussed earlier, or he spoke about, and that is why we have that provision in our tax treaty. I can assure the listener that only few countries, apart from Nigeria, maybe Philippines, and two other few countries, that have what we have called state taxation under the double taxation agreement. That means for other tax treaties, countries, they prefer resident taxation alone. But for us in Nigeria to encourage our airlines, we have the provision of the reciprocity, meaning that other countries or our treaty partners have, if they want to be exempted from taxation in Nigeria, just like the treaty suggests or provide, then they must allow our residents or an aircraft in Nigeria to also make income from that jurisdiction. So let me give you the, based on the example he gave, if, for example, Air Peace is unable to make income, or any aircraft or airline in Nigeria is able to make income from another country, a treaty country, that means the airline of that treaty country will be subject to tax in Nigeria. So that is what we have put in our treaties to encourage our domestic airlines to go abroad and derive income from other jurisdictions. And when we talk about reciprocity, reciprocity has to be airline for air, air transportation for air transportation, and maritime for maritime. For example, if we travel, we make income by airline, through our airline from a jurisdiction, but the other jurisdiction makes income only from marine sector, maritime sector, then the reciprocity has not been achieved. So for the purpose of reciprocity to be achieved, it has to be airline business for airline business and shipping business for shipping business. I also need to clarify on the issue of BASA. Now, BASA does not translate to reciprocity, and I will quote a provision from the tax treaties on the definition of international traffic. It says, the term international traffic means any transport by a ship or an aircraft operated by an enterprise of a contracting state, except when the ship or aircraft is operated solely between places in the other contracting state. What this means is that it is only what is considered as international traffic, and I will qualify for reciprocity, is only when it is transport by a ship operated by an enterprise of a contracting state. So if it is just a BASA sharing of routes, then BASA agreement has not translated to an enterprise of Nigeria operating transport by air or ship. So the issue of reciprocity will only be taken care of, or will only be noted where there is actual deriving of income from another jurisdiction by a Nigerian enterprise. And lastly, in the area of what we have done for the domestic airline by the policy of Nigeria, is the fact that commercial routes is exempted from, commercial transportation is exempted from the value added tax. Under the first schedule to the VAT Act, item 11 under part 1, it says commercial aircraft. So what is exempted? Commercial aircraft, commercial aircraft engines, commercial aircraft spare parts. So under goods, if a Nigerian enterprise purchase an aircraft or lease an aircraft and or purchase an aircraft engine or purchase commercial spare parts, all those items are exempt from VAT in Nigeria. So even when they bring those items to Nigeria and from the port, VAT will not be charged on that item. And also when you look at service, it says airline transportation under part 2, service exempted, It says airline transportation, tickets issued and sold by commercial airlines registered in Nigeria. So this also exempts transportation service by our airline from VAT. So what that means is that the airline business is exempted from the value added tax in Nigeria. So those are some of the provisions in the law that create incentives for our local or domestic business so that they can thrive and make income. It's when they make income that we are able to suggest income to tax. So it's also to FRS is our desire that those enterprises make income so that they can pay their taxes like any other responsible citizen or resident of Nigeria. Thank you.
Thank you. Thank you very much, sir. Thank you very much. That was a question you were supposed to answer. We'd like you in 1 minute. Someone had asked a question. I read it out earlier. He said, okay, how is minimum tax? I believe you answered the question earlier. You can just quickly give us 1 minute. How is minimum tax calculated on such international traffic?
Well, international traffic, it will come under section 14, subsection 4 of the Companies Income Tax Act. And as I said, it is 2% of full sum. So we need to underline the word full sum receivable. So that is the clear provision of the law, full sum receivable, not just profit element, but the total amount that the airline has collected. So this provision does not allow for any deduction of expense. It's just like under the domestic, under section 33, the minimum tax under section 33 is on turnover. So this also is also on turnover, on the full sum that the airline has collected. You apply 2% on it, and that will constitute the minimum tax. No deduction is allowed based on that provision before the application of the 2%. Thank you.
Yeah, thank you very much. I would like to, there's a question for Mr. Aliyu, Alaji Aliyu here. He said, how do you determine the tax residence of a cabin crew? Maybe of a crew of a ship or a crew of a plane. How do you determine tax residence of a crew? For example, a Nigerian who has got a job with Air France, for example, since we've started using Air France. How determine such person's tax residence, please?
Well, the residency rule of an individual is most countries use 183 days. So whenever you spend more than 183 days in any country, you are considered a tax resident for individual purposes. So, but for those captain and pilots that are on transit, you cannot say that they are living in Nigeria. But if they stay in Nigeria more than 183 days, they are considered to be a taxable individual under Nigerian income tax laws. But while they are here between 183 days, but they are earning income in Nigeria, which is borne by the PEs in Nigeria, then they are going to be taxed under the source rule as a non-resident individuals. Thank you.
Okay, thank you very much, Alaji Abdullahi. I'm sure you have done justice to that question. And in such, if they are, so now this leaves us with another question. Where they are 183 days, that means where will they file? If they are seen not to be 183 days, will they be subject to tax in Nigeria? So I want you to give us what is the difference between those that file returns with your office, which is a non-resident, and those that will file returns with Mrs. Williams. So can you give us the difference? At what point, I would like, maybe when you finish speaking, Ms. Williams will also speak. At what point do players in the industry have to file with the non-resident tax office or the domestic tax office?
Okay. Then those that are filing with my office, non-resident tax office, are those companies that are not incorporated in Nigeria. For instance, let me give you an example. Like I can use an example of MEX line and MEX Nigeria. You have an agent, you have the line. So the liners are the non-resident. These are the ones that are filing tax return with the non-resident person tax office. But the agents established purposely in Nigeria based on CAC, they are the ones that are filing in Nigerian tax offices with Madam Williams. So these are the differences, because most of the shipping line, you will find that they have an agent and then they have the liners. So the liners basically are the non-residents that are filing returns. Same thing with the airlines. All the international airlines, most people are filing tax returns with non-residents because they are not incorporated under corporate affairs commissions. So these are the categories that are filing with my tax office. I can leave the other hand for Madam to give further details. Thank you.
Okay, thank you. Madam Williams, can you also shed more light into the difference between those who file tax returns in the office and those who go to non-resident in the industry?
Thank you, Mr. Olarinde. You will recall that at the commencement of my discussion, I indeed explained what a Nigerian company is. And then I said Nigerian company is a company who has its activities controlled and managed in Nigeria. They are companies that are registered with the CAC in Nigeria. And so these are the companies that render returns with the domestic tax office, while the non-resident company do their filings with Mr. Abdullahi. Thank you.
Thank you very much. Mr. Kadishomo also wanted to intervene in the question I asked earlier. You have the floor, sir.
Yeah, thank you, Mr. Larinde. I also, maybe I should quickly add, in addition to what Mr. Aliyu has said, which is very correct, I also need to add that based on Section 10, subsection 5 of the Personal Income Tax Act, even when they have not spent 183 days in Nigeria, and maybe they have all their days, they stay aboard a ship or inside an aircraft. But if they sign article in Nigeria, based on Section 10 or Section 5 of the Personal Income Tax Act, they are liable to tax in Nigeria. So if somebody, maybe even in Nigeria or non-Nigerian, as long as that person has signed an article in Nigeria, that's the article of his employment on that, about that vessel, that article is signed in Nigeria, that person is liable to tax in Nigeria under the Personal Income Tax Act. Thank you.
Thank you very much. It has been an exciting time. If we still have any of our other panelists from the industry online and they would like to ask a question on taxation, I'd like to bring them in now. Do we have Ms. Madam Chisa on the line? Is she still here? Okay. Okay, if she's not around, okay, I think it's been an exciting time today. I'm sure our participants have gained some education today on the taxation of maritime shipping and aviation. The essence of the webinar and the essence of this taxpayer education is to ensure compliance in the Nigerian tax system. And we believe that the more we have this, the more tax system we improve. FIS is always available and open to partner with anyone. As we have partnered with Tax House today, we appreciate Tax House, and FIS is willing to partner with any other person to make tax education what everybody has, and so that we can enjoy that growth and improve the tax system in Nigeria. At this point, I would like to bring in the person who has called us together for this webinar, Mr. Olajide Omoshebi, the CEO of Tax House, to come in for his comments and close the webinar. Mr. Omoshebi,
Good morning, everyone, once again. And it has been humbling to bring together these high-profile panelists and for all the attendees who have joined us. Allow me to appreciate His Excellency Mr. Mohammed Nami, His Excellency the Chairman LRS Lagos State, all the wonderful panelists who have all joined us today to explain, to educate us on these tax obligations and giving an overview of the industry. I want to say thank you, thank you, thank you. Especially, I want to appreciate Mr. Femi Olarinde. He has been very supportive from day one. Also, Mr. Toby Wojola. Thank you very, very much. The partners at Tax House and the Tax House team who have put together this event, I say thank you very much. And to all the attendees, I say thank you. Your comments have been very encouraging, and trust me, this will be a continued exercise. Thank you, everyone. Thank you, and God bless you. Thank you.
Thank you very much, Mr. Mushebi, and for all the participants who have participated. The slides will be shared across to you for those who have registered, and I believe it will help you more to comply. Thank you very much. As we'll be signing on from here, I would like our panelists to just say goodbye to our participants before we leave. I would also like Mr. Manasseh, representing the Director of Taxpayer Service, to do that last. So I will start from Mr. Kaji Shomo. Just say goodbye to to everyone before we leave.
Yeah, as I said earlier, it is my pleasure to be here as part of this webinar series session. I want to appreciate the FRS team for bringing me on board, and for the organizer, Mr. Omakebi. Thank you. And for our audience, we are here because of you. Thank you so much.
Okay, Madam Olufunke Williams, please.
Thank you to our various listeners. Thank you to Tax House. Thank you, Federal Inland Revenue. And I'm believing and trusting that at the end of this session, there will be better compliance from the stakeholders. Thank you.
Mr. Aliyu.
Hello. I want to say thank you to the organizers and then the participants, and more especially. And I'm calling for all the non-residents guys or the non-resident taxpayer, whenever you have any challenge on compliance for tax authority, please don't hesitate to contact us. We provide you with one-stop solution to your problem. Thank you.
Then before we close, I'll call on Mr. Manasseh for closing words, sir.
Yeah, thank everyone else here. This was a wonderful presentation. I want to appreciate Mr. Femi for anchoring. I know our presenters, wonderful work. I will appreciate the other speaker who left us, the man from the captain. He was able to tell us from the inside, the practical operations, challenges in the sector. And I think our continuous engagement will help educate us more and other stakeholders on the tax compliance population of Nigeria. We want to appreciate the executive chairman for giving us this opportunity to anchor this program. We appreciate the presenters, our participants, all that made this function very effective. We appreciate Mr. Femi for this wonderful job he's been doing. On behalf of my director, Haja Yero, I say have a nice day and stay cool. Thank you.
Thank you very much, and we hope when we call you next time, you all avail yourself. Thank you, and have a nice day. Goodbye.
Thank you.
Thank you.